Alright, here's the big question. Why are the bond yields staying stubbornly high or swinging all over the place while the Bank of Canada starts easing up on interest rates? So now I'm here with Mark, my business partner, and he's gonna tell us about this topic.
It's like the markets and the central bank are playing totally different games. And guess what? This could be huge and have huge consequences for Toronto real estate market. Here's the expectation. When the Bank of Canada cuts rates, bond yields, especially long-term ones, should typically fall as well. Why? Because lower rates usually mean looser monetary policy and markets will adjust to that outlook. But this time, bond yields aren't playing along. They're staying elevated or swinging unpredictably. That's a big deal. So why is this happening? And why does it matter so much for you and for the housing market? Let's dive in.
So here's what's going on. The Bank of Canada is saying we are cutting rates to support growth and ease financial conditions. But the bond market is saying no, we are keeping yields high because we think inflation might linger or global risks are still looming. So this tug of war is creating a ton of uncertainty in the financial system and beyond. Mark is gonna continue and tell us more about it.
And there are a few big reasons why this could be happening, sticky inflation being one of them. Even as the Bank of Canada shifts towards easing, investors worry that inflation might not drop as quickly as expected. High yields are reflecting that nervousness. Government debt supply as well. Governments, including Canada's, are issuing lots of bonds right now to fund spending, and that increased supply keeps the bond yields elevated.
Now let's talk about the global market influences. US Treasury yields play a huge role in Canadian bond movements. If the United States Fed stays hawkish or inflation concerns persist there, our bond yield also stays high as well. Now let's talk about the risk premium, which is our number 4 in our list. So investors want higher returns to compensate for all the economic and geopolitical risks in the global market. That keeps yields high, even as the Bank of Canada signals a slowdown.
Yes, that's right. And here's why this matters for housing in Toronto. For fixed mortgage rates, high bond yields will typically mean that the rates stay high and they're not coming down as quickly as we expected, keeping affordability as a challenge for buyers. As well, for variable rates, when the Bank of Canada cuts, it does provide some relief to the marketplace with variable mortgages, but it won't be enough to offset all of the overall cost and burden of the debt of many households.
Mark, can you tell us a little bit of what we call it market confusion?
The market confusion right now between buyers and sellers is both of them are caught in the middle. Some buyers are hopeful rates will drop, while sellers hesitate, unsure of where the market is headed. Some of this market confusion can lead to risky decisions. Bond yields behaving this unpredictably and chopping. Jumping into the market right now can mean locking in at the wrong rate. Maybe even yields spike again. So it's like playing Russian roulette.
That's exactly what it is right now. So Mark, can you tell us what could be the possible outcome and what could happen next?
If bond yields stay high, fixed mortgage rates will remain expensive and housing affordability will stay strained, putting downward pressure on the demand.
So what will happen if bond yields drop later, for example?
If fixed rates drop later, then that might soften or create a window of opportunity for buyers, which could also spark renewed bidding wars, especially in a low inventory marketplace.
So overall, the combination of choppy bond markets and the Bank of Canada's gradual easing adds massive layer of unpredictability to the housing market. Buyers, sellers, and lenders all have to make decisions in a volatile environment. So the takeaway here is that bond markets are sending mixed signals about the economy. Even as the Bank of Canada lowers rates, elevated or erratic bond yields are also a sign that the markets aren't convinced that inflation is actually under control or that risk have faded, basically. So Mark, do you want to tell us more about it?
Yes, well, for anyone navigating this real estate market, this disconnect can be something that needs to be watched, and it could mean the difference between locking in a decent rate or getting caught off guard.
All right, thank you, Mark. That was a breakdown. So what's your take, basically? Are bond markets right to stay cautious, or do you think the Bank of Canada's easing will eventually bring yields down? Let us know what are your thoughts and leave us comments down below and hit the like button and share it with your friends and subscribe to our channels.
And if you have any other questions or anything like that about the marketplace, if you need some clarity between the lines of all of this chop and confusion, please give us a call or email us. Thank you so much for watching.
Have a good day. Bye.